Dissect and review the Fed's moves. We're joined by David Nelson, Chief Strategist at Belpointe Asset Management, and John Herrmann, Director of U.S. Rate Strategies at Mitsubishi UFJ Securities. Gentlemen, good to have you on the show.
Great to be back.
Thanks for having me.
All right, John.
Yes, ma'am.
6 years, $3.5 trillion later.
Yes.
Was QE a success?
I think when we look back in history, we'll probably conclude that it was very helpful in helping us overcome this enormous drag that the financial markets were undergoing in the crisis in 2009 and early parts of 2010. So I think in general, there's many reasons to be critical, but I think in general, people are going to say it was a good thing.
David, if you look at the facts, unemployment was at 10.1% in October of 2009. Now it's 5.9%. The markets, the S&P has recovered about 160%. Who could say this hasn't been a successful
Well, we've
program?
had a lot of asset inflation for sure. It certainly did that. And I would agree with John up to a point. I would say that certainly quantitative easing in the early part of this cycle, certainly it saved probably the financial system in the United States in 2008. I would take exception maybe with the last round of QE. I'm not sure we really did get anything out of it. And I'm encouraged that we're starting to move towards a path of normalization.
So if you don't think we really needed QE3, you must be very happy with the timing then that the Fed is pulling the plug now. You think the economy is strong enough?
I don't think it was a surprise. I mean, they've been pulling the plug. You know, this has been coming. I know Bullard was out recently saying maybe we should extend it. I thought the real surprise for me was seeing a dove, Kocho Lakata, from Minneapolis actually say, take the dissent here. He wanted more QE. So it looks like the hawks like Plosser and Fisher are starting to get their word heard. And I think it's a good policy to move forward.
John, can the U.S. economy sustain the withdrawal of the stimulus?
Okay, so if I just benchmark my forecast versus the Fed's, we've been way more optimistic in terms of the unemployment rate coming down faster than they thought. We've been more optimistic on the job growth. GDP growth, we've actually been a little bit more pessimistic than the Fed, and that's been fitting the data. And on inflation, we've definitely been lower than the Fed, and that's also starting to fit the data as well. So
you feel comfortable?
I would say if I looked at it, I would say it would be a mistake, I think, if they rushed a little bit too soon to start normalizing rates. And part of the reason why is because an unbelievable fraction of these jobs created have been part-time, low-wage, low-skill.
Before we get to the rates, I want to focus on the timing of the end of the bond buying program, the massive stimulus, the massive amount of free money.
I don't think we were getting much out of it, so I think the timing is fine.
Is it fine with the Asia and the Eurozone showing signs of economic slowdown now?
There are limits to what Fed policy can do. There's only so much you can do with monetary policy. At some point, fiscal policy has to take over. We need some help there. I know as a portfolio manager, maybe one of the missing ingredients that I'm not seeing right now is the next leg of this bull market was going to come from CapEx. We're not quite seeing that. I'm not sure the Fed can help that.
Well, it was supposed to come from CapEx. It was also supposed to come from really solid job gains. It was supposed to come from people returning to the labor force.
Can low interest rates really solve that?
No,
another year of zero?
We also have, we do have the problems you were mentioning. We have softer growth globally. And so I think, the issue is going to be...
How many mandates will the Fed take on? I mean, this Fed is taking on so many mandates.
One of the big things that has been supporting the recovery has been the housing market. So with the end of QE3, that's going to have an impact. How do you think that's going to translate to everyday Americans?
Housing market hasn't really, it's been recovering. It's really not following through in a way that people would say this is a meaningful follow through. It hasn't been meaningfully adding to GDP nor to jobs. So
we came out of a bubble there. It's going to be difficult for that to lead us out.
David, speaking of bubbles, many have argued that QE 1, 2, and 3 have now created over-evaluations. What have been the negative impacts of all of this?
You make a good argument. Certainly, the Fed can point to low inflation. But asset inflation is everywhere. Stocks, bonds, and real estate all benefited from programs that the Federal Reserve has put forth. I really took exception with Janet Yellen, taking on all these mandates, including income inequality. She talks about the 5%. The 5% have no better friend than the Federal Reserve.
Well, I mean, I just look at things from, if you were to look at the other side of the ocean and you said to yourself, okay, you're France, you're Italy, you're
Right.
Spain, suppose we're one of the, and suppose their local currencies still existed, like the lira still existed, or the peso,
Well, now
or the
we're
French.
going back
no,
in
no,
time
no, no.
here, John.
You know what they would want to do? What they would want to do is what we just did,
Right.
which is they want to do QE, they want to run up the deficits, and they want the central bank to be buying the debt of the governments to help them navigate through these problems. And that's exactly
I would
what
agree.
we did.
They're way behind us, and maybe it's their turn, but it's time for us to move forward.
What about inflation? There was this big balancing act between stimulus and inflation. Did the Fed play it right? Is it too late? Is it too soon?
You know, a lot of people who said inflation would be a real big problem have been proven wrong. Early on in this cycle, I was one of them. I thought this would cause massive inflation. That was clearly not the case. I think the big fear has been deflation. And on that front, the Fed has been right.
You know, I think from my standpoint, as I said earlier, my inflation forecast has been below the Fed, and we're going to see inflation go down to about 1%, 1.1, 1.2 over the next 6 months.
He's right.
And I think what you're looking at, and you know, from the standpoint of the Fed trying to reach its target of 2%, you know, it just doesn't seem like it's in the cards for the next 15 to 18 months.
All right. Well, let's focus on the statement of today and what we can forecast from that on the raising of rates. Some say could come sooner than summer of next year.
Earlier in the year, I wrote several pieces. I was looking for the end of the first quarter. I think that's going to be wrong, because before we can have a raise in rates, we're going to need a change in language. And we still have the language, considerable period of time when they're speaking of accommodation. You know, there's some history here. If you look at 2003 and 2004, when that language is removed and it's replaced with patient, then we can expect a Fed hike.
So the Fed needs
We're looking at least 6-7 months out. So I'm looking, you know, I think consensus right now is at July, and that's probably pretty
So
accurate.
you're waiting for the Fed to sort of soften the market into a rate.
Well, you can't say considerable period of time and then the next month
quarter
make a hike.
Here's some of the things that went on. So the markets in the last about 3 or 4 weeks have shifted from a point of view of pricing in a hike in mid-year of next year and pushed it all the way back into the fourth quarter. But yet the slightly more hawkish tone in today's statement had markets start to pull it back towards the midpoint of next year, but they have not fully moved it back to midpoint. So I think what's going to happen is this is where you're going to get a lot of uncertainty over the course of the next 6 to 12 months, and it's going to be an exciting time period of exit.
Exciting time period, and as you guys say, only time will tell how successful QE 1, 2, and 3 were.
We'll find out.
We're going to have to leave it there. Thank you so much, David Nelson, Chief Strategist at Belpointe Asset Management, and John Herrmann, Director of U.S. Rate Strategies at Mitsubishi UFJ Securities.